another episode of Module 2. We will be jumping into candlestick patterns, but before we jump into candlestick patterns, there are a few topics that I would like to discuss with you. These topics are very important before you start trading. That is why I call them trading essentials. The first thing that we would be talking about is entry. So whenever you see a candlestick pattern out there and you are planning to enter the trade, you have to wait for a confirmation, because candlestick patterns are around 70% reliable. So if you take 10 trades, there are chances that 7 of them would be right and 3 of them might backfire. So you have to be a bit more sure before you enter a trade. That is why we mark something called entry, and when you get an entry in a particular trade, then only you enter the trade. The next thing I'll be talking about is target. Before entering the trade, you will probably set a target that this particular stock might rise up to this level or fall down to this level, and when it hits that level, I'll be booking my profit. So that point would be called as your target. The third thing I'd be talking about is stop loss. This is probably one of the most important things that you would come across in trading. Stop loss is designed to control your losses. So imagine you see a candlestick pattern or anything which indicates you to enter the trade, and if the trade does not go into your favor and it goes in the other direction, you set a stop loss. So it minimizes your loss. Suppose you take a trade for 1,000 rupees, right? And you're expecting that trade to make you 1,500 rupees. But instead of going up, it started going down. So you set a stop loss at say 200 rupees, that I can afford 200 rupees even if it goes other way, because if it goes more down, it wouldn't really bother me because I have exited the trade at 200 rupees loss. So that is stop loss, and it is a very important thing, and I would recommend you to use that in every trade you take so that it can decrease your losses. The next thing I'll be talking about is short sell. So a lot of people who are new into stock markets or who do not really have any idea about stock market think that if the markets are going up, that is a good news, but if the markets are going down, that's a bad news and you are probably facing losses. That's not necessarily true. So you can even make money when the markets are going down, and that concept is called short selling. The whole point of trading is to buy low and to sell high. By that I mean, when you buy a stock for 100 rupees and you sell it for 150 rupees, making a profit of 50 rupees, you are buying the share at 100 rupees, that is buying it low, and selling it high, that is 150 rupees. Now, if you inverse the process, that suppose I do not hold any shares of a particular company right now, I sell the stock without even having the stock for 150 rupees, and then by the end of the day, I buy it back for 100 rupees. So I'm still buying it low and selling it high. I have just inverted the process. I'll still be making 50 rupees profit, and this is the concept of short selling. Short selling only works for intraday. So that means that if you sell a share without having it, you have to buy it by the end of the day. But what if we are predicting that the price of the stock is going to fall for the entire month? Can we short sell for an entire month? Yes, sort of. We can do that in option market, and we'll be coming into that in the fourth module, that is our option trading. The last concept I'd like to talk to you about is paper trading. So paper trading is for people who would like to practice without putting in money. Imagine you are someone who likes to watch football, who probably knows all the rules of football and who probably know how it is played. But if I put you in the ground with all the professional players out there, will you be able to play as good as them? Definitely not, because they have been practicing and training for years, right? Trading is also a skill set. You have to practice it before you become good. So to practice that, we have something called paper trading, where you do not really have to put in your hard-earned money in there. Instead, there are platforms that simulate the stock market exactly. The market, there are real markets and you're trading in the real markets, but with virtual cash, so that you do not blow up your account. Probably all of us have that one relative whose stories we hear that he or she put all his money in the stock market and ended up losing everything. I do not want you to be that relative. So be smart. First, practice before you enter the stock markets with your hard-earned money or any real cash. Practice for a few weeks maybe, or a few months. Whenever you are having an accuracy of 80%, 70 to 80%, you can then enter into stock markets. I think we will not be able to cover candlestick patterns in this video. We will be doing that in the next video, I promise. Till then, cheers. Bye bye.